Ever wondered how to predict the direction of Nifty? Well, you're not alone. Nifty, or the National Stock Exchange 50, is a benchmark Indian stock market index that represents a well-diversified, weighted average of 50 of the largest Indian companies. It's a barometer of the Indian economy and plays a crucial role in investment decisions. Therefore, predicting its direction can be a game changer for investors and traders. But how can one predict Nifty's direction? It's through understanding and applying certain key concepts, tools, and techniques. In this video, we're going to explore one such technique, identifying and interpreting support and resistance. These two concepts are vital for anyone looking to navigate the financial markets. By the end of this video, you'll have a good grasp of these concepts and how to use them to predict Nifty's direction. Now let's delve deeper to understand this better. To predict Nifty's direction, we first need to understand two crucial concepts: support and resistance. Let's start with support. In the world of stocks, when prices fall, a point eventually arrives where demand matches supply. It's at this level that prices stop falling. This level, or zone, where buyers demonstrate their willingness to purchase, is known as support. It's here that demand typically overwhelms supply, causing the price decline to halt and reverse. On the other hand, resistance is the exact opposite. As prices climb, a point is reached where selling starts to outweigh the desire to buy. It could be due to traders assessing prices as too high, or reluctance to initiate new positions at inflated valuations. This level or zone where supply starts to overwhelm demand is what we call resistance. With these concepts in mind, we can start our prediction process. Identifying support and resistance in Nifty can be done using a Nifty chart over multiple time frames. When we analyze the chart, we can identify these key levels where the balance of supply and demand has historically shifted. We mark these as our support and resistance points. For instance, let's consider we're marking the daily chart. We look for points where the price has bounced back after a downward trend, marking it as a support level. Conversely, we identify points where an upward trend has been halted and reversed, marking this as a resistance level. We repeat this process for the weekly and monthly charts, marking each level with a different color for clarity. These markings serve as a guide, helping us understand where demand has historically overwhelmed supply and vice versa. Once the markings are done, we need to prioritize them. Larger time frames, such as monthly and weekly, typically hold more weight than daily time frames. This prioritization aids us in making more accurate predictions. The final step in predicting Nifty's direction is to prioritize your markings. The order of priority should be monthly, then weekly, and finally daily. This hierarchy is crucial in understanding the broader market trends and making effective predictions. Now, let's apply these principles. For instance, consider the Nifty's May month prediction. The trend line shows a resistance at 23050 and a support at 22000. Additionally, the candlestick resistance levels from previous months are at 22550 and 20 and 22780, with support levels at 21800, 21700, 21500, and 21150. This data indicates a maximum range for Nifty in the upcoming month, from 21800 to 23050. With these steps, you can start predicting the direction of Nifty. Remember, practice makes perfect. Thanks for watching. Follow our social platforms for faster updates.